Welcome to the Rachele and Cassandra Show. Before we begin, our disclaimer. Rachele and Cassandra aren't attorneys or financial advisors. They are, however, licensed in their respective professions.
Hi, everybody.
Good day to you.
We're debating doing a countdown to starting the show. Little did we know we were well underway.
Yeah.
So
Hopefully
3, 2,
they
1,
edit
blast
that
off.
out,
What?
Nothing.
You
Nothing.
go.
No, you.
We are here today to talk about taxes and other hidden costs of home buying. Taxes in particular, and this episode is going to be very much the Cassandra Evers show because she deals with this on a more intimate and intricate basis than I do. So for me, it's a 10,000 intimate. Yes, I like that gesture. I'm a 10,000 foot view concept kind of person. Do not do that. Yeah, if you're watching, I highly recommend going to watch this episode just for that move.
Just stop.
Yep, that's all. We'll look up whatever time. I think around the 14-second mark, you'll see something amazing. Anyway, back to taxes. We're going to try and add some levity to a terrible topic that we both hate. But like so many things, knowledge is power, and the more you know, the better you can play the game. And here I go with concepts already. Cassandra, do you want to talk first?
Yes.
Or yet?
I would love to. Everybody, I requested this topic, even though it was outside of the scope of what we had planned to talk about following last week. But
we're inserting this here. Timely.
Yeah. It's extremely relevant, extremely timely. The tax bill for the winter just came out. It's December. In Michigan, every state's different, but in Michigan, we have tax bills that come out in the summer and tax bills that come out in the winter. And I wanted to talk about taxes and how they change, why they change, how that can change your monthly payment, how you can avoid it changing your monthly payment, and a little bit of the math, because based on what I hear, the vast majority of people who do my job do not mention or explain it to borrowers, or perhaps they do and borrowers forget, right? Because there's a lot of stuff you're being told.
Yep. And though I have little to contribute, I'm going to contribute it loudly and often. People who do my job often don't even talk about it with their buyers. I shouldn't say borrowers because it happens with buyers. That you buy a house in Michigan, the taxes change.
Yes. And we do have a sweet form, which we will link, right?
Put into the show notes.
Yep, we'll put it in the show notes and they can pull it up right now. It's the one that says Portage, a natural place to move, which
so this is just an example, by the way.
Delightful.
This is not something everybody can use.
So in the state of Michigan, this actually flows through to the entire state of Michigan, but the city of Portage sent it to me after I called the tax assessor and was like, "Dear God, man, what do you got for me to lay this out in addition to above and beyond what I'm already doing?"
So wait, I'm going to stop and repeat back to you what I think I heard you say. This document is just a state of Michigan tax explanation with a Portage logo stamped onto it. Okay. So anybody can use. This is not a form. This is an FYI.
Correct. This is not a form, or this is not a form that needs to be filled out. This is an FYI. In the city of Portage, the assessor sent it to me. He's so sweet. I was like, I'm fucking dying, man. Like, nobody talks about this. Nobody explains it to people. What do you have? And he goes, "Oh, I got the thing for you." So now I send this along with an explanation, and I verbally explain it to people because it's a lot to take in.
So the document's on the screen and I can see it. Are we going to be... Yeah. Oh, you can see it. Well, yeah, that's right. You can see that. Duh. Of course you can.
A duh.
Are we going to talk about this capped value formula? Because that, I want that.
Yes. So I wanted to talk about if it's on the screen for you. If it's not on the screen for you, it's worth opening if you want to know how taxes in Michigan work. Essentially, the transfer of ownership on page 1 of this form, kind of important, the transfer of ownership, so the sale of a property, right, or putting somebody else on title, it typically changes, it uncaps the value, the taxable value of the home, and allows the home to be taxed at a higher value.
No,
So
stop. So I'm just going to point out that the taxable value of a property is the state equal, not the same. Are we going to get into SEVs?
Rachel,
And
nope,
no?
I'm not
Okay.
getting into that because it doesn't fucking matter. It really
Okay.
doesn't. There's a taxable value. There's a state equalized value. They're different things. We passed Proposal A in like the 90s.
So
whatever.
For the purpose of this conversation, all we care about is the taxable value of the property, which is the rate upon which you are levied taxes by the taxing authority wherever you sit.
Yes. So I will tell you that I'm going to give a real life example. We bought our house. Adam and I bought our house 10 years ago, 11 years ago, whatever. We've been in the house a long time. And anybody who's owned a house for a long time could attest to this. We paid nothing for the house. It was a foreclosure when we bought it. It needed a lot of work. But so hypothetically, and you can actually go see how much we paid, but hypothetically, say we paid $150,000 for the house, right?
Yep.
My taxes are based on the sales price of the home. They were lower when I bought the house, and then I bought the house, the taxes went up. The values in my neighborhood now, 10 years later, are almost triple. So if I went to sell my house today and I sold it for $450,000, I'm currently being taxed at $150,000 because that's what I paid for it. Say it's worth triple. The new owner is paying 3 times as much as I did 10 years later. Their taxes for a really generic are going to triple.
Yep.
That's basically what it means. And it happens every time a home is sold.
Also, piece of important information, if you're getting a mortgage, so let's say I'm trying to buy Cassandra's house that she paid $150,000 for, and I'm going to pay $450,000 for. When I contact Cassandra to get my mortgage to buy her house, which sounds like double weird. So let's say I don't get my mortgage through Cassandra, which is ridiculous. Of course I would, but let's pretend. I am going to qualify for my mortgage based on the historical tax data. So I qualify.
The current value available. Yes.
Yes. So they're going to look at 2021 tax rates to figure out, right? My mortgage, my escrow account.
However, there's one instance where they do not do that. So anytime you're going to buy a house, an existing house, we qualify you based on the current taxes. Like
that's all they have.
Right. That's all we have. Those are the numbers we have. That's the only invoice we have, so to speak. The only time they make up taxes is when it's a vacant land and you're building a house or you're buying a new construction. So if the land's worth like 10 or 20 grand, it's just taxed at almost nothing, and you put $1 million house on it, we know the taxes are going to go up. And in that instance, every lender will go, hey, and I can tell you how we document it. There's multiple ways to document it, but generally speaking, I didn't want to get into the minutia. We are able to calculate what we expect the taxes to be, and they start an escrow account and your monthly payment with the new taxes. They qualify you based on the new taxes. I don't know why they don't do it in the other ones, but they do for new construction.
Only on a new build are you going to have a forward projected tax rate used to qualify you for your mortgage.
Yes.
Everything else looks back.
Your loan officer or your realtor, the math is really, really simple on how to figure out roughly what your taxes will be after you close. So this is the example I give to people.
I'm taking notes.
What happens is the title, you sign on your house, right? And you go to your county clerk and you go, I just bought this house, record my mortgage, record my deed. I own this house right now. And I change her name every time, but it's always a she. Sherry at the county clerk's office goes, thanks, hon, I'll record it. And then goes like this. Hey, Jerome, tax assessors in the office next door. Jerome, we have a house that just sold. Increase the value in the taxes on that house. Like Sherry takes it, gives it to Jerome, and Jerome goes, fucking sweet. Let's increase those taxes. Right. So they all work together. It's all out of the same damn office most of the time, but that's basically how it works. And it takes time to record that. So you usually won't see the increase until next year.
Yeah. Next tax bill comes due.
Yes. But remember, we closed you based on the current taxes.
Yes.
So what ends up happening is
on
the
your
tax bill comes.
$150,000
Yeah.
purchase price.
Yeah. So taxes are triple. So when the tax bill comes out the following year and it's triple what they planned, this is also what I tell people. Mortgage companies are dumb. They literally have millions and millions and millions of loan that they service. What they do is they get a bill and they go, write a check, put a stamp on it, fucking pay it. They do not balance a checkbook
Nope.
in any way, shape, or form. They don't flow through your specific account. They balance their own, but they literally just go, okay, I'm dumb. I got a bill. I paid the bill. I paid the bill. And one time a year, they go in and they go, okay, let's balance your ledger. Holy shit, we were expecting $3,000 worth of taxes. We got $9,000. We paid $9,000, not $3,000. And then they go back to the owner and go, huh,
You owe us.
hey, but they always make it seem like it's not a big deal. Hey, no big deal. We paid $6,000 extra last year, so pay us $6,000. And then going forward, we're going to need $6,000 more a year. So we're going to divide that by 12, and you're going to have to pay us this amount more per month for next year.
Which
If you
results
can't
in
write us,
the
and if
sticker
you
shock
can't write
of
us a
mortgage payment. Yeah, go
a
ahead.
giant shock. If you can't pay us this stroke a check for $6,000 today for what we paid last year, we'll just divide that in 12 months. So for the next year, you're going to pay us back the $6,000, and going forward forever, we're adding $6,000. So it turns into like the worst year of your life if you are not prepared for it.
And might I say, your little example about mortgage companies and how they run their business and do their books, I run my household just like a mortgage company. And right now is settlement time. So I'm looking back, having little heart attacks.
Oh,
Side story.
Run
You are
mine
a
like a
checkbook
loan originator,
balancer. Yes.
Rachel. Just so you know, these are all my transactions from the last, I don't know, week or so, to the penny. I'm balanced to the penny. No shocker.
Yeah. It's impressive.
So I wanted to talk about kind of how it works, right? Once you sell your house, the tax is uncapped, and it does change your monthly payment. There are ways to avoid that and prepare for it, though.
Okay, words. What uncap means that the amount that the taxable value of your property can be reassigned, like a new taxable value can be assigned to your property because of the change of ownership, right?
Yeah. So really basically in the state of Michigan, and I'm sure some tax assessor could get on here and really go to town, but really
let's get a tax assessor on here. I like that.
Okay. But really simply put, once my house sells and I've got that new value of my home, there is it can only go up really small based on millage rates passing, right? Like if I pass a new millage, like we're getting a county pool, right? Or something like that. And we all voted for it. In Kalamazoo, we voted to fund housing for homeless people. It was like a 664% increase, but I digress. But like,
are they tents or are they houses? Are they hotel rooms?
Exactly. Well, we don't really know, but they have an ass load of money to put them somewhere. So, anyway, so the millage rate affects it, but like as far as the value of my house, it can only go up incrementally. It's capped based on the formula, the capped value formula. So it doesn't really change much. But when you sell a house, that cap that like it can only change incrementally goes
bye-bye.
And it's based
your
on
$150,000 purchase price, or let's say your taxable value was $150,000, which it wouldn't be if that was your purchase price. But if your taxable value was $150,000 and then it got uncapped and the new value was $350,000, they can't just do that unless you do a change of ownership of the property. Like your value hasn't been steadily increasing right along with the value of your property.
Yeah, it would take me.
You know what it is? It's like locking in a gain or a loss on a stock purchase. If you buy a stock and it increases in value, there's no actual profit until you sell the stock. So your property taxes become effective when you lock in that gain or loss. So I suppose
which in this case is the sales price, basically.
So the opposite would be true, and this is a question because I'm thinking about when the market does the opposite of what it's been doing. When in a declining market, if I'm upside down on my mortgage, I can't make the payment, it sells at for pennies on the dollar in a foreclosure sale, which, side note, we don't really expect that to happen again. But black swan events, something weird happens. If my house sells for a quarter of what I've been taxed at, do they have to reassess it down?
Yeah. I mean, there's a whole thing about foreclosures and distressed sales. They know that they're not typical, but when they are all like if it's a standalone, it probably won't change that much. But
what do you mean if it's a standalone? What does that mean? I don't know. I know what a standalone. I know what those words mean.
If you go to the HUD home store today and look for every HUD or FHA foreclosure or FHA owned sale in the state of Michigan, you're going to come up with maybe 7. In about 8 years ago, you would come up with 15 or 20 per county.
Yeah.
Yeah. So it's.
So a standalone, you mean like a one-off outlier?
Like a one-off. They're not really affecting it now, but but yeah, communities do suffer, and your taxing authority, right? Their money starts declining when every home starts selling for less and less and less. So
the tax collectors' coffers have to always be lagging the market conditions. Period.
Yeah,
there's no getting around that.
Well, you'll see that communities have money when homes start selling for more, right? Their taxes more. They're generating more income.
Yeah.
So generally there's more services provided in higher area homes, but some of that depends on the millage rate, and
that's interesting too, because people like to complain about taxes, and I'm not looking to go way off into the weeds about this, but I think about our own parents when they sold our house probably 25 years ago, 30 years ago now. How long ago was that? Their house in Howell. They sold it. And I'm like nervous because my dad might listen to this, and I don't want him to think I'm like trash talking him. But one of the complaints that they had was that the taxes were getting so high. But you can't really have an improvement in value without an increase in taxes. So I think about, home sellers who want this top dollar for their house, but they're, I don't know, upset about the tax rate in that area. Like, you can't have both. You can't have, I don't know. I guess now I'm thinking about like Brighton versus Green Oak Township. You kind of can have both.
Well, so if I look at mine, I'm in Texas Township in Kalamazoo County, and literally a quarter mile away, right down the road, across the street, is the city of Portage in Kalamazoo County.
Yes.
So I go to city of Portage schools. I use their schools, but I don't pay their taxes.
This is Green Oak and Brighton, same.
Their millage rate is, oh God, I'll do it in percents. Their millage rate is about 1% more. So my millage rate's about 3.5% of the taxable value of my home, and their millage rate is 4.5%. And for that 1%, what they get that I absolutely know I don't get, I do not get leaf pickup. I do not get brush pickup. I do not get bulk yard waste pickup, right? I know that these are services I don't get, and I don't have city police officers. So I'm at the beck and call of the 2 county cops who are on patrol at any one time, or maybe 4 or something. So like those services are diminished for me because I don't pay for them.
So, and you had referenced like community pool. If your community is putting in a pool, like I think City of Howell residents get access to Thompson Lake. I have a Howell mailing address, but I'm in Genoa Township. I don't get Thompson Lake access. I do for free, but included in my membership of the community. I guess it's a better way to language that.
I do not get a library membership included in my residency.
Right.
They do have, my township has made it so that they're like cooperating libraries. Yeah. I can choose one, but yeah.
So let's talk about millage, because what the heck does that word mean? People vote on millages, but that seems like a kind of a complicated word. I know it's like a mill is not even totally sure. It's like
I'm not getting into the weeds on mills and millages.
no,
but
I'm
it's-
not asking you to get into the weeds, but you use the word millage, and people listening may not know. I do this for a
Okay.
living, and I don't exactly know what a millage is. It's like something per thousand, blah, blah. I know what it is when I vote on things that have a millage increase because they always explain it when I vote.
Yeah,
What is
it's millage is basically a multiplying rate based on the taxable value of your house, and sometimes it's applied to everybody county-wide, sometimes it's township-wide, depending on the verbiage of the millage. It has to do with taxes and the rate that your property is being taxed.
You are so good. Okay, so I'm Googling this while you're talking.
Oh boy,
And
how
it's
close was I?
No, your last sentence was almost verbatimly perfect. Is verbatimly a word? We'll have to check that out later.
Should be.
A,
I'll
a,
Google verbatimly while you tell me the Google response for millage.
and this is from Michigan.gov. A millage rate is the rate at which property taxes are levied on property. But what I was really looking for is the next sentence. A mill is 1/1000th of a dollar. Property taxes are computed by multiplying the taxable value of the property by the number of mills levied.
Yes, and so I turn it into a percent usually because you have to get a dollar amount. Like, so if it's a $400,000 house, the taxable value is typically half of that, so it's going to be $200,000. And if you're in a place with 35 mills, you're basically going to take 200,000 multiplied by 0.035, and then that will give you your annual tax. You divide it by 12 for your monthly tax.
Okay.
It's a really simple formula, but it just sounds complicated because of words, because of the words.
Words and legal language. Legal language likes to make everything sound harder than it actually is, right?
Yes.
Because words matter. So can we take a minute and talk about, and this is, I don't think it needs to take too much time, but if I know us, we might overdo it.
That doesn't sound right.
I know.
That doesn't sound right.
Well, let's test the theory. Tax prorations and the four ways. And I know that this is not quite in alignment with the topic as stated, but if you're buying a house in my side of the state, our side, generally, and it's always according to custom, which is infuriating.
Hold on.
Custom, yes. And that is such a nebulous term because it becomes a conversation about it almost depends on who you ask. But
it totally does.
For the purpose of this conversation, the general rule of thumb, and this gets really freaking dumb and immeasurable, but if you buy a house in Livingston County, for example, when you buy that house, taxes are, and I'm air quoting through this whole freaking sentence, taxes are viewed as though paid in advance. So that is the custom. That means that when I pay my tax bill that I just got for my winter taxes, that's due on, I think it's due on February 2nd. Don't quote me. If you're
14th.
February 14th, even better.
Yep.
Valentine's Day. What a gift. Anyway, so when I pay that tax bill, if I sell my house on February 14th, after I've paid that tax bill, the new buyer is going to reimburse me for that entire tax bill because it is viewed to cover, well, hold on. It's due. Cassandra's eye rolling. That's not true because it's due in February, but it's issued in December. So it covers December 2021 to December 2022 or the end of November 2022. So they would reimburse me for taxes I paid. Yeah, that's right. So ignore the first version of what I said. It doesn't, because if I didn't pay that tax bill, the title company would collect the entire tax bill from me and then collect a prorated amount from the buyer and reimburse me for that. So if oh my God, see, over explaining. If my taxes are $100 a month, hold on, let me try again. If my taxes are $100 a month for my winter tax bill, then I would pay $1,200 to cover 2021 to 2022. If at any point in that year I sell my house, the new owner will have to reimburse me for what I prepaid.
Yes, that's how taxes in advance work. Da, 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 da.
Thank you.
Yeah. So really, prorations, she said a word but didn't explain it. Prorations are essentially how you're going to split the property taxes, the shit
Yes.
that's already paid for, the HOA dues that say they're due January 1st
Either
and
the
you close on January 20th. Well,
and
you
this
paid for
it
the
applies.
entire month.
Yes.
You
Sorry,
paid
it
for the whole
applies
month.
to paid or payable.
Yeah. Okay, go ahead.
No, you. What do you do on your side of the state? Generally, rule of thumb. Generally, not the right way. We both have an agreement that we're about to culminate at, but custom,
We actually do calendar year.
that's customary on your side?
It is now. It has been for
Let's-
like 2 years, and I couldn't be happier. But
Yeah.
she said there's 3 ways. There's paid in advance, saying like I
There's
paid the
4,
bill and I
actually.
paid it forward for the whole year.
Yep.
So if you buy a house, you're going to owe the seller, which means closing costs on the other side of the state, on the east side of the state, are way fucking higher than in West Michigan.
Yep.
There's also places that
Not because
say-
it's more expensive, but because you're just
Because of the
prorating
taxes.
differently. It's not really more expensive. The money just flows differently. Right? Yeah.
the amount due at closing is more.
Yes. Yes.
It's always more in East Michigan, on the east side of the state. So there's the east side of the state, which does it in advance, like you're prepaying your taxes. And so you as a buyer are going to have to reimburse the seller. There's also paid in arrears, and there's locations in the state where they say you're basically squatting. So if you buy a house, the seller's been squatting, right? Or and the seller ends up having to pay the buyer back.
Yeah.
And then there's also calendar year, which says, and this is actually what every local taxing authority will tell you, which is the tax bills that come out in that year are for that year, which is why it says 2021 summer and 2021 winter. It's for that year.
Yep.
That's the year it's for, and that's it.
And I think the confusion comes out of the tax bill that just came out that I have at my house right now says 2021 winter tax bill. Well, winter goes into next year. And my guess is some real estate closing once upon a time with an attorney and a title company and a realtor and a homeowner, and it just started to get really fucking muddy. And that set the stage for all of this local custom BS, because the calendar year would, if everyone got on the same page for a calendar year, then my 2021 tax bill, if it was $1,200, would cover January 2021 through December 2021. And the prorations would be easier across the board. Your real estate contracts would be smaller because there are literal paragraphs with check boxes in that have to do with this. And I can't tell you, side rabbit trail, how many times I've made my clients money because the agent on the other side didn't understand their own contract. And because I'm aware how my client bought the house, I can make them money by, I have had title companies call me and say, oh, hey, we just need to have an addendum fixing the tax proration because the contract says it should be as though paid in advance, and we do paid in arrears. And I'm like, oh, I know. I know what I wrote. Do it the way the contract says. There's nothing to correct.
This is why I said it's more expensive generally to buy a house. And your contention is it's not more expensive. There's more money due at the closing table because of prorations if you're buying in a paid in advance area.
Yes. Versus paid in arrears.
There's
versus
less
paid
money due
calendar
if you're
year.
doing there's less money due if you're paying in arrears. And then if you're paying the calendar year, that's literally the best, most fair way to go, because that's what the taxing authority will tell you. The bill that comes out for that year is for that year.
Well, I would argue with if it's the most fair, because fair to who? Fair to the system maybe, but if my client did a reimbursement based as though paid in advance, then they're going to take a little bit of a financial loss if they go calendar year when they sell. So somebody's going to have to pay the piper. So there's go ahead.
Anyway.
I agree with you. I fully freaking agree with you. Like, the system needs to be corrected, but when it comes down to, this is like a NIMBY problem, right? Like, the people are like, well, yes, it should be that way, but I don't want to pay the penalty. I don't want the trash heap in my community, but I still want to generate trash.
Right.
It's like the same mindset.
Well, So we're a little off topic. We're on prorations, but we're talking about, so I'm not quite done with property taxes. We
Okay.
talk about property taxes, how they change, why they're changed, when they're allowed to change. It can change your monthly payment. The only
A
way,
lot.
the best way to avoid it changing your monthly payment is to waive your escrow account. Don't have an escrow account. Don't put money into your monthly payment. Your monthly payment's made up of your PITI, right?
Yes.
Principal, PI, interest, T, taxes, and I, like mortgage insurance, right? So if you take the
Oh, and
taxes out of the
insurance
equation,
and property insurance. My
principal,
hazard
interest,
insurance,
taxes,
taxes and
insurance. I'm
insurance.
sorry, and mortgage insurance. So if you take the taxes out of the equation, your monthly payment will be less, but it will be stagnant and constant and not change. So that's one of
Now,
the things people hate when they have an escrow account.
this is also worth mentioning, and I'm not trying to interrupt you. I'm actually trying to make sure things get said before I fucking forget them. When you're shopping mortgage companies or products, I would definitely encourage you to ask about your principal and interest payment only when you're shopping. Because if I call Cassandra and she says, well, if you buy that house, your payment will be $1,500 a month. And I call someone else and they say, oh, your payment will be $1,400 a month. If they're both including an escrow account, then that payment estimate includes an estimate of taxes that could be off high or low. So shop mortgage products based on principal and interest. It's always going to include, if you have a, what did you call it? Mortgage insurance. If you have a mortgage insurance, that'll help you determine the product. Anyway, yes, in the weeds. Sorry.
So no, you're fine. And it's a really good point. I just quoted a kid who was buying a house and he sent me the other lender's numbers. And I said, hey, just so you know, my taxes are more, but they're accurate. Here's the taxes I'm seeing. What had happened was
Right.
I actually quoted him the first week of December. Guess what came out the first week of December?
Tax bills.
The 2021 tax bill.
Yes.
They
And a
had
lot of,
quoted him at the end of November and the tax bill wasn't out. So they were using the last year's tax bill to figure his numbers.
and might I applaud you for using a tax bill, because often I see blank, like not blank, just a filler number, like realtor math, right? I do dirty realtor math in the field. I'm not a loan officer, but I have quick and dirty so I can get in the ballpark. Is this going to be a $2,000 mortgage payment or a $1,200 mortgage payment? And I use, depending on where I am, $250 or $300 for the escrow taxes. That's a totally made up number that should be in the range-ish based on the price range we're in. It's not real.
Well, so as a loan officer, part of my job is numbers and accuracy, right? Not only to find the product, but so I look up the current actual taxes when available. Sometimes they're behind a paywall and sometimes communities don't report, but current actual taxes. And then I actually do the math on, hey, just so you know, the current taxable value of this home is $53,400. Your taxable value after you buy the home is going to jump to $127,000.
It's huge.
And then the math based on the millage rate means your payment, your monthly, the tax bill is going to go from $167 a month to $427. So if I were you, I would pay $275 more per month. And people kind of glaze over initially, but then it takes a minute for the explanation to stick, which is what we're talking about at the beginning of the show. Like, it really fucking matters. And
it does,
that's
especially
if I put a single mom in a house and it's a $700 payment.
Yeah, and that
but
payment
it's
jumps.
I know it's, and I don't even tell her it's going to go up $150 or $200 or something.
Well, and forget single
kind of an
mom. Let's
asshole.
just say anybody who's
Anybody.
most buyers buy at the top of their budget, not at their comfort level. Like, often you may qualify for X amount. Doesn't mean you have to spend that much, but often home buyers buy at the top of their approval. And that approval is based on historical taxes for the home you end up buying. And if those historical taxes are capped 20 years ago, just know what's coming. There's nothing wrong with what's coming, but it is coming. And knowledge is power.
Yeah. And just to let somebody know, like, your taxes are going to change. Your taxes will change. They will go up. They will not go down. I've had people ask me like, so are they going to go down? And I go, what fucking world do you live in?
Well,
No. When's the
there's
last time
a
there was a tax decline?
no, the rate wouldn't decline, but let's talk about if you buy a non-homesteaded property, because that's one thing that I check when I'm helping a client buy a home. The majority of the areas I serve are homesteaded properties. So there's property tax exemption, which gets you an approximate, let me just say it,
Tell them the
35%.
difference. But tell people the difference.
I will. But I'm telling them why first. So if you have a homesteaded property, it's your primary residence, and the result of having your property homesteaded is you have an approximate, I've heard 30 to 40, so I always quote 35% overall reduction. Cassandra's making all these gestures. I will let you talk, I promise. Approximate 35% reduction in the overall tax rate of your property. And that's like amortized over the annual tax rate for summer and winter taxes. But if you do not have a homestead, so that would be like your second home, or if you own more than one home, you can only have one homestead. Those taxes are not having a homestead tax reduction. What? I got to let her talk.
Okay. The difference between homestead and non-homestead: homestead's your primary residency. Non-homestead, it's an investment property, a rental property, a second home, something like that. You get a tax break on your primary home. The tax break is actually 18 mils. It's
off of one
mils.
tax, yeah, but it's only off of
or
one tax bill. It's off your
actually
summer tax bill.
Nope. It's actually totally not. It's not either off of winter or summer. Every community can collect taxes however they want. I'm in Texas Township. And for me, in winter, 80% of my tax bills collected, 20% in summer. Mom and dad are in Portage, literally 3 miles down the road. They are 90% summer bill, 10% winter. It's different in every community, but
I did not
the
know
homestead reduction is 18 mils or 1.8%, right? Most areas are at about between 35 mils, right? And you're going to take 18 off, or 45 mils. Romulus is like 77 mils because taxes vary so wildly. So it's really important to have somebody local who can find the taxes and do fucking math and knows how they work.
So my 30 to 35% quote is after if you took your annual tax bill, and it must only apply to the area that I primarily work in, because this is what the title company explains to the client at the closing table. I'm just saying.
It's very broad. Your city of brightness, way more than Genoa Township.
But nobody is saying that it's a 35% reduction in your winter tax bill or anything like that. I think the shakeout is if you don't file your homestead exemption paperwork, your taxes revert to non-homesteaded rates, which results in a effectively 35% increase in your annual tax bill.
Yeah, there's a form that gets filed at closing. The title company usually files it on the borrower's behalf. I've had a title company
That's not true.
forget
We do
several
not.
last year.
We do not on our side, and that's why. Because the liability from that document not being filed would go with the person in charge of filing it. So title companies that I do business with will mail in the property transfer affidavit for the seller, but will not file the homestead exemption and property transfer affidavit for the borrower. They refuse. Because of exactly that. I had a realtor one time offer to do it for her client, and I was like, "What are you, insane? Why would you do that?"
It's a big responsibility.
Huge.
Drive the piece of paper up. You'll save money. Rachel, just so you know, in your township, I have your house pulled up, but your winter bill is 6.8616 mils.
Okay.
And so you multiply the taxable value of your home, and that's your mils.
Low. That must be where I'm getting my discount, my homestead.
Your summer bill is, what they do is they total it. So your summer bill's 34.0939 mils. However, you have to subtract 18 off of that because your homestead is actually in the summer.
Oh, so the percentage gets applied first. Why do they do that? Percent. Why would we have
your
winter
taxes
and summer
are like
bills?
some of the lowest in the state? I don't know if you know that.
I do know that. And I know
Yeah.
we can't do politics, but I know why.
Yeah, your tax rate is like less
Because
than
I don't have a community pool.
2.3%. It's 2.3%, which is dirt cheap. I
Yeah.
mean,
So can we?
it's super
Do
cheap.
you know why we have winter and summer tax bills? Because that seems silly to have it. Not only to,
Not
I
every
guess
state does.
if it was a 50-50 split, that would make more sense to me. But this 80-20 here, 90-10 there.
I think the state law at some point, and I do not know the history of it. Again, we need an assessor on. I think at some point they went, could we collect half of the bill now so that we don't have to wait till the end of the year to get money? And they went, sure. And then they went, could we collect 80% of it now and then 20% in winter? Because our bills are all due in July or something. So I think like over time it just started eroding or something like that. I don't know why there's two, and then why it can vary so wildly. Like I'm super winter heavy. Mom and dad are super summer heavy. So it's
Sounds like I'm summer heavy too.
you are summer heavy. Like your summer bill's double what your winter bill is.
That feels right.
Yeah.
Well, dang. So
Yeah.
our parting. Oh, yeah, we've been talking for a long time about this. So our takeaway is expect your payment to go up or expected your taxes to go up. Right?
Yeah. Yep. And if you don't want the payment to go up, don't get an escrow account.
How do I not get an escrow account? What's the rule?
Ask if you can waive it. That's the best way. There's no cut and dry yes, no. Some loan programs won't allow it, some will, some require down payment, some lenders require you to pay a fee to waive it, some do not.
You know what that means? Oh my gosh. That means it depends.
It depends.
Real estate goggles. Always put on your real estate goggles. Oh yeah, okay, so we have our image of the taxes. They will always go up. Unless values are plummeting, in which case we've all got bigger other problems.
And in which case it's a fire sale. And you don't care if they go up because you're leaving.
That's right. Sweet. Let's do this again as soon as possible sometime. Where are you going?
Okay.
You're going somewhere. Can we talk about that?
I am.
Where are you going?
Italy.
Can you look at some real estate in Italy just to bring back some nerdy real estate information?
Totally.
Yes. If you
I'll
can
try to find one of those villages where I buy a house for €1.
Yes, do it where you have to like maintain the island and you get to live in the house for free. Or if they do open houses, go to a fucking open house. Do it.
All right. Yeah.
It's a blast.
It'll be fun. I mean, it might be a little stressful, but it'll be
open
good.
House. Amazing. Awesome. Well, thank you for joining us. And
Arrivederci.
Nice. Try that with an accent. Arrivederci.
I'm kidding.
El
I did it
Americano.
with like a really hard arrivederci.
Yes.
Yeah.
Ex les thermes. See you later.
How about gabagool?
What is that?
Gabagool is capicola.
I don't know what that word means either.
Meat? Capicola? Have you never had capicola?
Oh, are you? No. Wait, is that like the ham, bacon, really skinny, super fatty?
Yeah.
I don't like
you
it.
could see through it.
I don't like that at all. Yeah.
What about prosciutto?
Yes. Only if it's cooked, though, not raw. This is not even in the weeds. We just went into like we're in a meadow now.
Yeah. Stop. I hope they stopped the recording before that.
But they didn't. Goodbye.
Bye.
The info given is current as of this recording, but remember, the market changes and real estate is hyper local.